and 30 minutes session. So please make sure they all join us for us to start or for us to proceed with the session. Okay, so quickly, since the meeting is being recorded, let me share my screen so that we all start. Okay, so all right, so I believe my screen is visible. My audience can see my screen and they can also hear me very loud and clear. If my screen is visible and you can see my screen and hear me very loud and clear, as our tradition, you give me one in the chat, you drop one in the chat for me to know if, of course, and indeed you are all following, you can see my screen. Just drop one in the chat. Just drop one in the chat. Just drop one in the chat. Maui Senam. Wow. Is that not Doris? Maui Senam. Hey. Okay. All right. So I believe it's true. All of you can hear me very loud and clear. Yes, I saw my way cinnamon. I thought it's you. you. Hmm. All right. So guys, let's start. Now, one of the interesting parts of our journey is becoming a beginner in trading. And when you are a beginner, you have every opportunity here to grow, to learn, and make money. So you learn, you grow, you make money. You learn, you grow, you make money. So the only moment someone strive in making serious money is when that person has been able to learn and grow. Do you get it? So now, when it comes to we making money, of course, despite everything that is being provided, you should understand that the money you make is as a result of the knowledge, it's as a result of the knowledge you do what you have. Do you get it? Now, if it happens that you want to make more money, it is not more money that gives you more knowledge. It is more knowledge that gives you more money. And it has been tested and proven for many years. Do you get it? For many years, the number of people that has existed, big men that we call them billionaires, and so on and so forth, we've got to realize that most of them, their wealth doesn't come as a result of just them making money, but they did something out of the knowledge they had. So this simply means if you want to grow, if you are the type you care about your financial growth, then the first thing that you need to do is to learn. And the more you learn, the more you grow. And the more you grow, the more you do what you make money. This is one thing a lot of people lack. So most people jump into industries, they have less knowledge, and yet they want to make billions of dollars within a short period of time. That is one, it is called you are hacking the system. And anytime you decide to hack the system is meant to hack you if you decide to do it to hack the system. Do you get it? So in our journey towards trading, it has been known, it has been tested, and also for many years it has been proven that whoever wants to make money in this industry should strive hard to learn and then grow. To learn and grow. And the more you learn, the more you grow. The more you grow, the more you make money. Are we together? So coming back into our industry, that is RoyalQ. RoyalQ. Now, as we all know, the work of the bot is to trade. Is to do what? Is to trade. Any other thing is additional purpose. But the main purpose of the bot is to do what? Is to trade. Which simply means whenever we talk about making money, the first principle is about trading. If it's about trading, we know that we don't trade on the forex market, we trade on crypto markets. When we talk about the crypto markets, there are different aspects of trading on the crypto markets. But over here, our discussion has always been limited and been not as in limited, but we focus. The word is focus. So we focus on the spot and then also on the futures. Now, one of the unique thing about RoyalQ is both on the spot and also on the futures market, trading is done applying what we call the martingale. Do you get it? Trading is done applying what you call the martingale, both on the spot and then also on the futures. Martingale is the essential key. Then the next part of it is greed. Mind you, this is beginner session. So first we talk about spot. What is spot? How does martingale react on the spot market? And how does martingale react on the futures market? That is what we are going to do. If you are following, give me one in the chat. If you are following, mind you, I've slowed down. If you think I'm speeding up, you can alert me. If you're following, give me one in the chat. Let me know. Are you following? Are you following? Good. Very good. All right. Let's proceed. So now, spot market. Spot market. Now, when it comes to spot trading, if you're a beginner in the crypto market, one of the areas that everyone will advise you to venture is the spot trading or the spot market. One of the areas that every trader would advise you, every experienced trader would advise you to first venture is the spot market. Now, why do people advise traders or beginners to venture into the spot market? Because there are easy and accessible opportunities on the spot market with low risk as compared to the futures market. For instance, on the spot market, the first thing that you can do on the spot market is to hodl assets. And basically, when we talk of hodling an asset, that is storing an asset or keeping an asset for a long-term use. So mostly, traders hodl assets, and this is done on the spot market. That is, you buy an asset, and then you wait for the price to do it, for the price to increase. And as the price increases, either it decreases or it decreases, always your focus is to ensure that you are going on a long term. That is for hodling. So you are holding the asset for a long-term purpose. For instance, as we are seeing the price of BTC around 64K today, if I intend to buy parts or I intend to buy 64 shares of this particular BTC, I can decide to let it be for some years or some time, and that is called hodling. Now, aside on the spot market, we can also perform just like other markets. We can also perform what we call day trading. day trading. Now, day trading is applicable on all parts of the market and also on the spot market. So the idea of day trading on the spot market is such that traders can be able to do what? Buy assets at a lower price and sell it at a higher price. Now, the process of buying low and selling high is mostly termed as dollar cost averaging. Dollar cost what? Averaging. And this dollar cost averaging is being applied by using what we call the martingale rule. The martingale rule. Now, when we talk of the martingale rule is a mathematical principle which helps investors. Listen, the martingale rule is a mathematical principle which helps investors to keep tripling or to keep increasing their gains as a market or as investment goes against their favor. That is how the martingale works. So I'm going to take time to explain this two, that is the dollar cost averaging and then the martingale, which they all work line in line or hand in hand. So on the spot market, on day trading on the spot market is such that the trader focuses on how he can make short gains, short-term gains based on market volatility or based on price fluctuations. And basically, we know that just like any other market, crypto fluctuates or the crypto market fluctuates. When we say prices fluctuate, it simply means that the rate or the price does not stand permanently on its own. Basically, the price goes up today. Within a short period of time, you see the price it comes down as well. And if we're a spot trader, it is based on this volatility, the up and then the down. That is how traders make profits. And if it's possible, you must learn how price goes up, price comes down, so that you can be able to make better profits on the spot market. So on the spot market, as usual, you are going to buy low and then you do what? You sell high. Now, how do you buy low? How do you sell high on the spot market? Applying the dollar cost what averaging. So first, the idea of buying low simply says that search for an asset or get an asset with the lowest price. So getting an asset with the lowest price simply means that, for instance, let's use BTC as an example. Within a particular time, we could realize that the price was around 65,000 or 66,000, and now it dropped to 64,000, which simply means that now it is at its lowest price. And since the price is at its since the asset is at its lowest price, traders on the spot market will decide to do it to buy assets that is called BTC, so that when the price moves from 64,000 to maybe 64,800, they can be able to take price advantage over the price and they make more profits. Mind you, 64,000, and then it increases from 64,000 to 64,800. So immediately the price moves up or the price rises, it is expected that we are going to make what? Profit. Now, on the spot market, you should also understand that the fact that you bought an asset at a lower price doesn't mean that it would always continue to, after buying at a lower price, to go up. It can be that we buying BTC at 64,000, the price can keep going up. Sorry, it can keep going down. That is 64,000 to 63,000, 63,000 to 62,000, in that order. Now the question is, what do we do? What do we do? Let me know. Are you following? Are you following? Are you following? I'm taking this lesson from the scratch because I assume you are a beginner who would need more and easier understand about the market. So I'm taking time to explain things to you better. Are you following? Are you following? Hmm? Good. Very good. Good. Let's go then. Let's proceed. Let's proceed. Now, since the original price was around 64,000, and now it keeps going to 63,000, 62,000. What can save every trader who is in such market is what we term it as the dollar cost averaging, that is DCA. That is what makes RoyalQ to be so unique here. So with the dollar cost averaging, this is how the market moves. We know that price moves and then price fluctuates. So this is an original price. Let's assume this is a candle, right? This is a price. Now the price gets down here. It moves a little bit up like this. Then it gets down again. It moves up like this in that order. Now the price drops further here. Then it moves up again, small time, then it drops down below again. This is what we call chart. So you look at the time or you look at the chart, you realize that the price was here. I bought it at this point. Now it moved a little bit here and the price dropped below. Do you get it? After the price dropping below, it increases a little bit, but not up to the zone at which I bought the assets. Then it drops again. It increases, then it drops even further as compared to the original price. Then it increases a little bit before it drops again. Now this is the lowest price, right? This is the lowest price on the chart. Looking at this, what we are saying that with dollar cost averaging, the trader can be able to simplify and make extra profits while the trade keeps going against you. Are we together? So with this, the first thing that you need to do is that consider the asset you want to buy. And I will talk about the assets. This time around, let me talk about the dollar cost averaging first. So with dollar cost averaging, assuming I bought the asset at $3, my entire capital is $100, right? It simply means I'm not going to use all these $100 to buy the asset, but I'm going to use parts of this $100. One of the mistakes that lands a lot of traders into trouble is providing all their money or investing all their money in the same market at a go. It is a very big mistake if you want to be a good investor and a good trader in such a market. Then the idea is to apply dollar cost averaging. So investing all the money in the market within a blink, it's a mistake on most parts of beginners. On most parts of beginners. Are we together? So what I have to do is that I have to make sure that now I simplify my money into different strategies such that now let's assume if I choose to buy $5 at this price and the price increases further, I will make profits. Now below, when the price goes further again, I can choose to buy $10 in addition. When the price increases further, I make profits. When the price gets below, I can choose to buy another $25. Now when the price increases, I make profits. Now I can choose to buy another $35. So let's see, 5 plus 10 plus 25 plus 35 is giving me how much? Let's see, let's do the calculation together. 5 plus 10 plus 25 plus 35, you're going to get how much? 5 plus 10 plus 25 plus 35, you're going to get how much? Let me get back. You're going to get how much? Here it is 5 plus 10 plus 25 plus 35. Yes, 75, 75, 75, 75. That is awesome. 75. Good. Let's go. So now, with this 75 that we have here, it simply means we still have another $25 remaining. Since our total capital is $100, we still have another $25 remaining. So if we decide to buy another $25, if we decide to buy plus what $25, now everything is making $100. Now, this entire process is what we call it the martingale. Martingale. Do you get it? This entire process is what we call it the martingale. It simply means we are creating an avenue where we can be able to buy low and sell high, buy low and sell high. But mostly, one of the mistakes that most traders, beginners do is that now the person will now decide to do it, buy $50 first. Now, as the price keeps going down, then you buy $5, $3, $2, $1. No, the cheaper the asset, the more you should buy. You shouldn't buy assets at an expensive price and then expect to be buying it with a cheaper price instead at a lower price. So let's assume, let's do this. You join a market or you go into a maize farm. First, the farmer decides to sell the first product at, let's say, $200. Now, the price becomes so cheaper that now he said, okay, I'm selling more assets at $100. Between $200 price and then also $100 price, which one will you get the opportunity to buy more? Between $200 and then $100, which one will you get the opportunity to buy more? Let me know. Between $200 and $100, which one will you get the opportunity to buy more? Which one will you get the opportunity to buy more? Let me know. Between $200 from the farmer as a price and then also $100 from the farmer as a price, which one will you get the opportunity to buy more? Yes, yes, very good. I'm not yet on futures, please. I'm not yet on the futures, please. I'm still on sports. I'm still on sports. So hold on. We are chewing the meat gradually before we chew the bones. We are chewing the meat gradually before we chew the bones. You can't just chew the bones. You get it? Very good. So now it simply means we are capable of buying more with $100. So which simply means if I understand dollar cost averaging very well, I wouldn't first rush into the market buying very huge amounts with the first amount and then buying small with the remaining capital. No, I have to rather do it, buy less with the first amount and then also do it, buy more with the remaining amount instead. So there is a rule in mathematics. We said if more, let's divide. If less, more divide. So in this case, since the opportunity at hand is too cheap, I have to increase my since the supply is too cheap for me, I have to increase the demand. That is called the rule of demand and what supply. When the price of an asset becomes so cheap, we buy more, we don't buy less. Listen, when the price of an asset becomes so cheap, we buy more, we don't do what? We don't buy less. So one of the principles of trading is applying what you call demand and supply in trading. Demand simply means the price is up. Supply simply means the price is down. Now, if there are more supply, simply means the price is cheap. And if the price is cheap, create demand. Buy more. So you don't rather buy more when the price is expensive. Do you get it? You learn to buy more when the price is rather cheap. That is supply. So when the supply is low, you increase the demand by buying more. Do you get it? Very good. So now that is for dollar cost averaging. That is for dollar cost. So you can take your time, learn more about dollar cost averaging. That is the assignment I'm giving you. Dollar cost averaging. And mind you, all big and institutional traders apply dollar cost averaging strategically in their trading. Dollar cost averaging is important, and mostly it's used by what you call the quant traders, which is quantitative traders. So since RoyalQ by nature or by itself, it's also a quantitative bot. It uses the same quantitative analysis to do what? To analyze the market based on the same procedure. That is the reason why anytime you apply dollar cost averaging, you may be making more profit on your sub cells. That is a great opportunity, but most people don't know. Right? So let's assume we have an asset we want to trade. The next part of it is what is the asset. Now, someone may ask, so can I apply dollar cost averaging on every asset? On every asset? The answer is no. The answer is what? Is no. Now, when it comes to spot trading, mind you, this is beginners class. This is what? Beginners what? Class. When it comes to spot trading, the most important thing you should consider is the assets you trade. The most important thing you should consider is the assets you do or you trade. Now, the assets you trade really matters a lot. One interesting thing about the crypto market is it is interesting and funny at the same time that most traders follow what you call hype. Most traders follow what you call market hype. So today they see this asset that there is more hype on that asset, they jump on it. Another day you see another asset that there is more hype, they chase it. Now, if you're a beginner, never ever chase hyping assets. Assets with hype, never chase it. Especially, there are certain assets that they don't solve any real problem in the market, but because some people intend to hype the asset so that they can make money from that asset. Now, most hype assets comes as a result of that. There are certain individuals who want to make good use of your money in the market. That is all. So it's just like publicity. Okay, publicity. So they publicize the assets, they decorate it, publicize it until weak investors intend to invest most of their money in it with the intent that they are going to make quick returns. This is the reason why, as a beginner, you need this class for you to know that when it comes to trading, trading is not about hype. Listen, trading is not about what? About hype. I said trading is not about what? About hype. Trading is not about hype. Take notice of this. If you follow hype, you might end up making a lot of messy and mystery mistakes in your journey. There was a time they said there were prophets, some prophets prophesied about certain crypto assets, and a lot of people jumped on such assets. They began buying. Today, if I tell you the price of that asset, you marvel. It's sad. If you really want to go bankrupt, follow hyped assets. You can easily go bankrupt. And one thing about following hype assets is that if you don't know that type of asset you are following, you might end up going broke with no hope in the future of the asset resurrecting again. Do you get it? So never ever chase hype in your trading journey as a beginner. Never chase hyped assets. Now, dollar cost averaging is more suitable on assets that we may term them as chain assets or blockchain assets or utility tokens or utility assets. Most of these assets are built on their own blockchain, on their own ecosystem, and they have got good value. So, for instance, let's talk about Bitcoin, Ethereum. Bitcoin, Ethereum, Bitcoin, Ethereum, Solana, XRP, and many other assets. Now, most of these assets, the fun part of them is that no matter how they dump, there is 95% or 99% probability that they will surely rise again with time. That is when you apply dollar cost averaging on these assets, they gives you more confidence and more hope in the market. But if you end up applying dollar cost averaging on a hyped asset, which in the near future you don't know its fate, such that you end up investing in it, the next time you see, you keep buying the dip, you keep buying the dip, then the dip dips you. You keep buying the dip, then the dip dips you. You keep buying the dip, then the dip dips you, until you realize that all your money is exhausted and the coin is yet to be delisted. Are we together? Are we together? Are we together? Are we together? Am I here alone? Am I here alone? Very good. Very good. Very good. Very good. Very good. Let's proceed then. Let's proceed then. Let's proceed then. Let's proceed. So you see, once you fail to understand some of these concepts in the market, you might end up thinking that, oh, since I'm a beginner in trading, I want to blow, I want to make money, I want to make quick money in the market. That is not how we make quick money in the market. Do you get it? That is not how we make what? Quick money in the market. Quick money must be made with intentional. So you see, quick money must be made with what? With good intentions. So you see, we have some of these assets here. As you can see, all of these assets are to be delisted. They are under monitoring to be delisted, to be delisted, to be delisted, to be delisted. You get it? Now, this doesn't mean that they weren't once good. They were good, but they were good in their own performance. So, therefore, it is advisable once you keep growing in your trading journey, if it is possible, you learn on the assets that is good to trade with good future, and also which can give you more hope in the future, even if it's happened that it keeps dumping, like BTC, like Ethereum, like Solana, and so on and so forth. So some of them, you see, when you come to coin market cap, let's see, when you come to coin market cap as an example, let's use it for now. So when you get to coin market cap as an example, for instance, you're going to see the first 100, the first 10, the first, so BTC, Ethereum, SRP, BNB, Solana, can see where are they? So very good. You can see them here. You can see them. You can see them here. Some of these assets, if you apply DC on BTC, if you apply DC on BTC, Ethereum, XRP, or BNB, or any other asset, Solana, and the market keep dumping, and you still have money to do more, you will never regret. You always feel comfortable and live in peace. You get it? But don't worry. Come and search for not coin. Apply DCA. Go and apply DCA. So some of you just come, you join crypto because you saw someone just use $20 and turn that $20 into 200 million. So you also want to bring your 200 million, you want to turn your 200 million into 400 million. Don't worry. You begin to turn your 200 million into $20. You begin to turn your 200 million into what? Into $20. If you don't know what we are talking about, if you don't understand what we are talking about, you let your $200 million turn to $20. That is when you begin to realize that no, the principles are not the same. The principles are not the same. Trading is not about gambling. Listen, trading is not about gambling. It's about making an intentional decision. It's about making an intentional decision. Intentional decision simply means you are really aware of what you are doing and you know the outcome. Do you get it? You know the outcome. So when it comes to RoyalQ, our focus to ensure that we train beginners to understand and make good decisions about trading and the market itself. So if a trader decides to apply dollar cost averaging, like I asked the question, is it any asset at all that I can apply dollar cost averaging? And the answer is no. So you intend to go and go and buy not coin, and you said you apply dollar cost averaging, no problem. You can apply. But until when not coin will perform to its highest peak for you to know that the asset that your first buying amount wouldn't tend to be the last thing in the market will be another thing. Do you get it? That is the reason why we are saying no. It's not every asset. It's not every asset. Focus on assets that is capable of rising with time and then also giving you the necessary results with time as well. So when it comes to RoyalQ, with dollar cost averaging with martingale strategy, so for instance, come here, let's click on an asset, right? Good, we click on create. So over here, you can see we have martingale strategy and then also the great bot. Now with martingale, this is what they are telling you. They said buy separately and sell in a whole. With grid, they said buy low, sell high automatically. Buy low. The advance of the grade is the martingale. Take note of that. Once martingale is so important and it's profitable, especially in bear markets, the advance of the martingale is of the grade is what is martingale. And funny enough, martingale is not so common in most of exchanges. That is the reason RoyalQ have made it so unique here for traders to use. So with martingale strategy, the idea is simple, such that if a trader wants to apply the martingale strategy, that is what we've just explained. It's about buying the assets at a lower price, since buying it at a lower price, and since the market keeps moving in ranges, you buy low, you sell high, you buy low, you sell high, in that order. Do you get it? Now, let's move on to the next part of it. Mind you, on the spot market alone, there are a lot of lessons, but I want us to move bit by bit. Since next week we will continue, let's move on to futures. because I want you to tap the knowledge on both spot and then futures as an introductory part of our beginners class. Now, there are other traders who also thought of it. No, we want to trade, but for me, my challenge is that maybe I want to be making fast profits. That is one. And then also, even though I'm a beginner, but I love taking serious risk. Even though I'm a beginner, but I love taking serious what? Risk. Are we together? Even though I'm a beginner, but I love taking serious risk. Yes, of course, I know some people, if they allow you or if they ask you to sell your kidney, you will sell. If they ask you to sell your kidney, you will sell for money. So far as money is involved, you don't have problem. So far as money is involved, you don't do what? You don't have problem. You will sell your kidney. Now let's discuss about the futures market some more. Mind you, this is beginners class. Now, futures trading. So on RoyalQ, we trade both on the spot and then on the what? On the futures. Futures trading is also one of the interesting parts of the market or trading, which gives you money and also which takes money away from you. Futures trading. Now, in your scope of trading journey, you must have fair knowledge about both the spot market and on the futures market. Do not think of it such that because they said, oh, there is more money in futures, so I'm just going to trade futures. You must understand futures trading as a beginner. Do you get it? You must understand the basis of what of futures trading. So when it comes to futures trading, no, let me hold on. Let me see if you are following. Do you understand the discussion? Do you understand the lesson? Do you understand? Do you understand the lesson? Mind you, I've given you a gist of sports, and I'm also giving you a gist on what on the futures. At least you go home with some knowledge on sports, you go home with some knowledge too on what on the futures. Like that. So you'll be taking it bit by bit in that order. And on Thursdays too, we handle the advanced knowledge on crypto trading. On advanced knowledge, we go on deeply futures and deeply sports. Anything crypto. So far as RoyalQ is concerned, our purpose is to enlighten you. Hmm? Now, let's proceed. Since you are following and you've gotten the scope of the lesson. Good, good. Now, this is it. Futures trading. Futures. Futures trading. Now, you see, just as I told you, on the spot market, you are buying the assets at a lower price so that you can sell it at what? At a higher price. You can apply dollar cost averaging on the spot market. Now, on the futures market too, what does it do? How does it work? And how do you also use the various opportunities there? This is it. Unlike the spot market where you are buying low, simply means you are owning the asset. You buy the asset, it belongs to you, you own it. So you bought it at a lower price and you're waiting for the price to go up, you sell it to make profit. Over here on the futures market, it is not like that. The futures market is about either longing or shorting. Pay attention to this. It's about either longing or shorting or buying or selling. We either call it short or sell or long or buy. They are the same. If you don't see long and you see buy, they are the same. If you don't see short and you see sell, they are the same. Do you get it? Now, what does the long means? What does the short means? Buy, sell on the futures market. This is it. First, the idea of trading on the futures market comes with rule of contracts. A contract's rule. This is the rule that there is a market. Listen, this is the rule of the market. Come with less money. Let's borrow you more money. Use our borrowed money to leverage and make more profit. Let me repeat. Come with less money. Let's give you a borrowed money. Use the borrowed money to leverage and then do what? Make more profit. So it's a contract. They are borrowing you money. That is virtual money, not a withdrawable funds, but virtual money. So that you can leverage on that borrowed money to make more profit or to make profit. The condition is that you are using this your less capital as a collateral. As what? As a collateral. Which simply means this huge money that you are going to borrow, if anything happens, what is going to happen? We've not gotten there yet. If anything happens, you are going to use your less money to pay for whatever happens, whatever bad that happens. Listen. So the money is being borrowed to you as a virtual fund, and you are using your less capital as a collateral to the borrowed money or the borrowed fund. What you are going to do is that now you are going to trade on this market, either going to long an asset or going to short an asset. Now, the long and the short of this market simply means that, let's take BTC. BTC. Just like the spot, unlike the spot market, you realize the price is down at 64K. So you bought it with the anticipation that it will get to 65K. Since the price could get to 65K on the futures market, the trader who is anticipating the price to go to 65K would long the assets. Listen, will sign the contract that I believe with conviction that the price will go up to 65K. So I am longing. Listen, since the price will go to 65K, I borrowed money to long this market. So why are you longing? Based on your prediction that the price will go to what, 65K. That is the reason why you have borrowed the money to make more profit. It simply means when the price goes to 65K, as you have analyzed and predicted, of course, your longing position will bring you profit. But if for any reason this analysis that you've made that the price would have to go to 65K couldn't go to 65K, though you bought at 64K, you longed it at 64K, and the price couldn't go to 65, and it keeps going below 64. It keeps going below 64. It simply means the market is going against you. Now, there is another trader who also said, no, as for me, I believe the price will not go to 65. The price will go below 64. So let me short it or let me sell it. So selling simply means you are predicting the price to go down, so you are selling. And the person also longing or buying simply means he's predicting the price will go to what, 65K, so he's buying. So with the person who is shorting the asset, if the price goes below this, he's going to make profit with the borrowed money. And you too, if indeed the price goes up, you are also going to make profit with the borrowed money. Give me one in the chat. Let me know. Do you understand what you are saying? Do you understand? 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 Hmm? Do you understand? Do you understand? Do you understand? Do you understand? Okay. Okay. So someone saying got confused with the time borrowed money. Someone say go over again. Someone say no. Okay. Now let me go over again for you. Let me go over. This is what we are saying. I've agreed to a contract. The terms of the contract is this. It's either I am agreeing price will go up or I'm agreeing price will go down. Now, if I agree that the price will go down, if the price is going to go down, my money is, let's say, $10. And I said the system should borrow me $50. Okay? The system should borrow me what, $50 to make profit on this asset that is dropping. It simply means I've borrowed the money. My actual money is $10, but I've borrowed $50. Do you get it? I've borrowed $50 to make profit on this asset that is going down. In this case, if the price keeps going down, I will make more profit on the $50 that I've borrowed. Now, the condition is that if the price couldn't go as agreed or as planned, I'm going to use this $10 to pay for the money that I borrowed. Do you get why? Because the money that I borrowed does not belong to me. It's a virtual money that belongs to someone, the exchange, that they borrowed it to you, the trader. And the agreement is that you are going to make profit on it. But if you couldn't make the profit or as planned or as agreed, you are going to pay with this $10. You are going to pay. Mind you, the continuation of it, like the leverage and so on and so forth, will be continued on the advanced lesson. I'm just explaining the basis of futures trading to you. So, since the price is supposed to go down, I'm expected to make more profit on this $50, not the $10. I'm going to make profit on this $50 that I borrowed. And the $10 is what I'm using as my collateral. That is called margin. Okay? The $10 is what I'm using as collateral to this $50 that I borrowed. So if I'm able to make more profit, I go away with my $10 capital together with the profit that I made. If I couldn't make profit, the exchange would down decide to do what? Close the trade. Since I'm losing all the money in the market, they will take my $10 and then end the trade for me. That is all. So over here, the futures market is a simple contract based on a borrowed money called leverage. So you are leveraging on something. Listen, you are leveraging. Now, when we say leveraging, it simply means you are using less effort to produce more results. Less effort, more results. Less effort, more results. Less effort, more results. So when someone is leveraging on something, let's assume we are carrying 10 bags of cement. 10 bags of cement. Now, if we are two people, it simply means you have to carry five. But if we are 10 people, we just have to do what? To carry one. It simply means since we are many, we have leveraged by reducing the effort. Do you get it? Another example is jack, jack, car jack. Okay, jack. Now, if it happened that you are to carry a car or raise the car with your energy, you can't. But with the help of the jack, you can lift or raise the car to certain level or limit, which is called leverage. Which is called what? Leverage. So the jack is serving as what? As leverage. Even though you by your own energy you cannot raise or lift up the car, but using the jack you can now raise the car to a certain standard. If you understand, do you understand? Do you get it now? Do you get it now? Do you get it? Let me know if you get it. Do you get it? Do you get it? Let me know. Let me know. Let me know. Do you get it? Do you get it? Very good. Very good. Very good. Very good. Very good. So, Marian, Olise Marian, hope you get it now. Do you get it? Samuel Nyama Ahen, hope you got it. You get it now. Do you get it now? Do you get it now? Okay, so Zoom is asking, but if you are running at loss, will it eat into your capital? Okay, so let's expand the lessons more. Mind you, this is only beginner session. This is beginner session, okay? Now, this is it. So what happens on the futures market? It's either I'm using the jack to make more money. The purpose of the jack is to help you do the work easier. So on the futures market, the borrowed money is to help you make easy profit or fast profit. And that how the fast profit is made will be explained in the advanced class. Listen, they borrowed you the money. Your capital is $10 and you want to make $5. On the spot market, it's not so easy to use $10 to make $5. Unless the market has got high momentum to rise very fast. If not, it's not so easy to use $10 to make $5. But on the futures market, because of the borrowed money, why? Because you have $10 and you've borrowed $100 with $10, which is 10 times 10. Do you get it? 10 times 10. So with 10 times 10, you can make, that is 100. That is the leverage. You get it? So since you have $100, we're expecting to make profit on this $100. And the probability that you can easily make profit on this $100 is high because it's huge capital as compared to $10. So in this case, if it happens that the market is eating the money, automatically, if it eats beyond what it's supposed to eat, automatically the trade will do what? Will exit by taking your capital and helping you to go back home in peace. That is what mostly you may hear of the word liquidation. Liquidation. We are not discussing much about liquidation this evening. This is just, we are just talking about the introductory part of it. So the question about if your money is being lost, yes, of course, it will take the capital, which is the $10, and ask you to go home in peace. The trade will be exited or closed automatic. This $10 does not belong to you again. Mind you, you have $10. You said you want $100 of your capital, which is $10. So you have $10, you want $100. They've given it to you, and you agreed that if anything happens to the money, they should take away my $10. So they've done justice to that. So on the futures market, a trader decides to either go on long or short. Now, going on long simply means you are anticipating price to go up, and going on short simply means you are anticipating price to go down. Now, in both cases, dollar cost averaging can be applied. In both cases, dollar cost averaging can be applied. Now, mind you, a trader can predict or can expect price to go up, whereas the price keeps going down. And what can save the trader is if I can still be buying more as the price keeps going down, I can be able to make profits from the price that keeps emptying. Mind you, price was around 64,000. I expect it to go to 65,000. It went to 63,000. Now, I bought it at 63,000 again. When the price gets to 64,000, will I make profits or I'll make losses? I bought at 63,000. Even though I bought at 64, anticipating it get to 65. It went to 63,000 and I still bought it again at 63,000. Now, if the price goes up to 64,000, do I make profit or I lose? Do I make profit or I lose? Yes. Do I make profit or I lose? Let me know. Do I make profit or I lose? Do I lose or I make profit? Yes. 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 Good. I make profits. I make profits. Very good. I make what? I make profits. I make profits. Now, that is the exact thing that we are talking about here in terms of dollar cost averaging on the futures market too. That is the exact thing we are talking about on the futures market with regards to dollar cost averaging. So you realize that dollar cost averaging both on the spot and on the futures, it's applicable. It's applicable. And since it's applicable, you can do it both on the spot and then also on the futures market. And profits can be made. Have you learned something good? I'm taking it step by step. I don't want to rush the lesson. Let me hold on. If you have any question, ask your question. I know it's 10 something in East Africa, and most people are beginning to sleep beside their device. Oh, someone is saying the network is breaking. Can you hear me very loud and clear? Am I loud and clear? Someone saying the network is breaking. Can you hear me? Can you hear me? Very good. Very good. Very good. Very good. Good. So now, what I'm saying is that both on the spot and on the futures market, dollar cost averaging can be applied. Both on the spot and on the futures market, dollar cost averaging can be applied, and it's profitable and suitable for every trader. Now, the most important thing is if you are a beginner, understand these two markets, know your potential, know your investment appetite, your risk appetite before you do what you decide to make decision that trading on the spot market or on the futures markets. Whereas all these two markets are good, know yourself. Do you get it? Let me hold on. If you have any question, left with 13 minutes for us to bring the session to an end. Let me give you opportunity for you to ask question, right? Let me give you opportunity for you to ask question. Let me give opportunity for you to ask question. Okay, so someone is asking, you lose only the capital. I don't get your question. I don't get your question. You asking you lose only the capital. On the futures market, please, if you have any question, drop it in the chat box or you raise your hand. If you have any question, drop it in the chat box or you raise your hand. On the futures market, listen. On the futures market, if you are to lose, there are two ways of losing. Either you've applied stop loss or dollar cost averaging or anything. Now, if you are losing based on liquidation, if you are getting liquidated, you get liquidated based on the money that you've exposed to the market. If you have $1,000 that is in the market and liquidation happens, all the $1,000 will go. And you see, like I said, this is introductory or this is beginner's class. We have the advanced lesson where we talk about the isolation and then also the crossover, or sorry, cross. The isolation and then the cross, where you know how money gets liquidated on the spot, sorry, on the isolated markets and then also on the cross markets. All right. So if you have any question, so you lose only the capital and liquidation doesn't enter your balance in your exchange. Okay. So yes, for that one, it's true. It doesn't enter the balance. It depends on either you are using isolation. It depends on either you are using isolation or cross. If you are using isolated, then it's safe. If you are using cross margin, it's all the money in your, not in your entire exchange, but in your futures account. You get it? It eats all the money in your futures account if you are using cross margin. Okay. Please, Zoom, do you get it? Your name is Zoom. A trader before he loses his capital. At what percentage? So now on the futures market, before a trade will go against the trader, it simply means that 100% of his margin has been exhausted. 100% of his margin amount, which is the $10 that you exposed, has been what? Exhausted before that trade will be liquidated. So before you be liquidated, it simply means 100% of your margin has been exhausted in the market. That is it. Please, do you get it? Okay. Now, I don't have any question today, but I need settings for $10 on futures account. Okay, so I guess this is an introductory lesson, and if we are to touch more on trade settings, it may expand our lesson to another session. So, Michael, I wish you pardon me for this. I wouldn't be able to set up a trade or guide on settings for $10 because this session is only a beginner session to expand their knowledge and understanding about the market. We have session on trade settings as we did every Monday. We have sessions on trade settings. If not, our advice maybe after the meeting, you see the person in charge or your upline or chat me privately or anything on the platform. You have the Revolution platform. You can also do that there. All right. So what are the indicators that cost is dropping? Samsung, can you come again? What are the indicators that cost is dropping? I'm not getting your question. Samsung, I'm not getting your question. Can you come again? Samsung, I'm not getting your question. Can you get back again? So guys, if you have any question, kindly ask your question from what you've discussed this evening. Kindly ask your question from what we've discussed this evening. Kindly ask your question from what we've discussed this evening. So we take it step by step, bit by bit like that. Every Thursday too is advanced session. Mind you, this is beginners class. For beginners in the market. So Thursdays is for advanced class. So you can also feel free to all right. So someone is also asking that so Samsung is asking to enable you buy more at less price. Samsung, please can you ask your question in full? Can you ask your question in full? Can you ask your question in full, please? Okay. In the spot, you buy more at the lowest price. In the spot, you buy more at the lowest price. How does this apply in the futures? Yes, so the same. If it is on long, listen. If it is on long, if it is on long, you buy more at the lowest price when the price keeps going down. Do you get it? If it's on short, you buy more at the expensive price while the price keeps going up. So you see the twisting turn of it. On the futures, if it is on long, you buy more when the price keeps going down. And if it is on short, you buy more when the price keeps going up. Please, do you get it? Nyaku, do you get it? Very good. Now, thanks so much, Brother Emma. I need to understand how dollar cost applies when you short the market. When you short and the market goes against you, the asset becomes more expensive. Okay, so this is it. Now, I short a trade. I short a trade. I short a trade. I mean, this is short, okay? At what point in time can I buy more? At what point in time? I can only buy more when the price goes up. Do you get it? I can only buy more when the price goes up, because when the price goes up, then it begins to turn back again. That is when I can make profit on those ones that I bought. Just like it went out and it's getting back home. So if it is getting back home, all those things, all those ones that I bought on my way, I will see them again. That is where my profits, that is where I can make the profits. Because it will get back here. Listen, let me draw the line again. This is the entire line. This is it. Hmm? Now, I'm expecting to make my profits here. This simply means if the price goes beyond this side, it has to get back all the way here. So if I'm able to buy something here, if the price is going up like this and I buy something here, by the time the price will reverse back, I'll make profits here, I'll make profits here, I'll make profits here. Before the last profits that I have to make, I'll make it here. So as the price goes down and I'm anticipating to make my profits, when it goes up and I buy more, when it's getting back home, that is when it's dropping back, I'll make back my profit. I don't know if you get it. Do you get it? I don't know if you get it. Sylvia, do you get it? What is the difference between long and short? What is the difference between long and short? What is the difference between long and short? Now, when we say someone is longing, please pay attention to this. When you say someone is longing, the difference is that one is buying the assets at expensive predetermined price, that is at an expensive price. One is also buying it at a lower price. Mind you, this is prediction. This is not as in buying on a real time on the spot market as in buying. But the difference is that one is predicting the price will go up, one is predicting the price will come down. It has nothing to do with the expensiveness of the prices. It has everything to do with the trend, how the price is going, but not necessarily the price, the real assets or the real price of the assets. The focus is on how it keeps going up and how it keeps going down. It has nothing to do with its expensive price or its lowest price. But the most important thing is how it can be able to follow the trend you are anticipating or expecting. Please, do you get it? So that buying is based on all what we've discussed, is also fit in with margin configuration. Dollar cost averaging uses margin configuration. Without margin configuration, dollar cost averaging is not effective. So whatever we are talking about here forms habits or part of the margin configuration, to which on our next discussion we will talk about it. So please don't worry, okay? On our next discussion, we will talk about it. Right. Okay. On our next discussion, we talk about it. All right. Let me know if you have any other question. Is there any other question? I believe you've learned something this evening. 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 Let me know. Did you learn something new this evening? Right? I believe you've learned something this evening. I believe you've learned something this evening. I believe you've learned something new this evening. Let me know if you did. I believe you've learned something new this evening. I believe you've learned something new this evening. All right, that is awesome. That is good. That is good. That is good. So, ladies and gentlemen, we will end here this evening. It's 7:31 in Ghana. You spent an hour and 30 minutes here. This meeting was recorded, and you can go back to our YouTube channel. It will be uploaded there tomorrow if God permits. So I urge you go back to our YouTube channel, watch, subscribe, and watch the videos there. And if you don't understand anything, always our platform is open for questions and answers. You can feel free to ask, and leaders are always ready, prepared to answer and guide you grow in your trading journey. Mind you, as a beginner, like I said initially, the idea of we training and bringing you here is to ensure that you learn You learn, you grow, and then also make money. You learn, you grow, and make money. And the money you make is as a result of the knowledge you have. The money you make is as a result of the knowledge you have. So the knowledge you have, the depth of your knowledge will determine the money you can make in the industry of what? Of trading. I want to see you growing all the time. I want to I want you to keep pushing. Don't look left nor right. Keep going, and I believe the results will definitely get closer to you. Let's keep learning and let's keep doing the right thing, and surely we'll get the result that we want. Guys, we will end here for this evening. If God permits, we shall meet again tomorrow. Sound sleep and have a good night. Love you all. Bye, 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 bye.